In this video we are going to talk about cheap dividend stocks. So before starting this video, please like this video and subscribe to this channel for our future updates. As a result of the recent volatility on Wall Street, the share prices of a number of dividend stocks have fallen. And while there is always the risk of catching a falling knife, as the old investing adage goes, it can sometimes be advantageous to stake out a position in long-term income assets when we witness a short-term contraction such as this one in the market. Right now, the stock prices of the 7 inexpensive dividend stocks listed below are all less than $10 per share, and they all pay dividends of 2.5% or higher. That's a huge increase above the usual S&P wink with tongue sticking out 500 components yield of just 1.3%, and with cheap dividend stocks, you may simply buy shares in large quantities, as well as little amounts. All cheap stocks are not equal, but here are 7 that stand out from the competition. Number 7. Aegon NV, ticker, AEG. While not a household brand, Dutch banking business Aegon is unquestionably a cheap dividend stock to keep an eye on, especially after its shares have increased by more than 35% in the past year. Although it has enjoyed a successful run, the stock's current price is still only approximately $6 per share. AEG is a $9 billion company that provides insurance, pension management, and investing services to clients all around the world. Increased interest rates have been a godsend for AEG, as they have been for many other financial equities in recent months, thanks to its mix of relatively stable long-term clientele that allows it to deliver in whatever economic climate. Just keep in mind that, like many other international dividend companies, it does not pay dividends on a quarterly basis, as do dividend payers in the United States. Aegon only pays out 2 distributions per year, and the size of each distribution might vary dramatically. However, based on the payouts over the past 12 months, the yield is still rather large. Number 6. NLC Capital Management Incorporated, NLY. People looking for income investments on the cheap may consider NLC, which not only has one of the highest yields on Wall Street, but also has one of the lowest share prices of any company on the market. Internationally diversified capital management, NLC Capital Management invests in residential and commercial real estate assets, typically through mortgage-backed debt and other illiquid financial instruments. Although the price of this cheap dividend stock has fallen recently due to concerns that rising interest rates will dramatically raise its borrowing expenses, dividend payouts have remained constant at 22 cents per quarter, providing a great yield despite the stock's low price. Number 5. ASE Technology Holding Company Limited, ASX. ASE is a semiconductor stock based in Asia that does not actually manufacture chips, but is instead involved in services such as circuit packaging and testing, among other things. This is a lower margin business than owning your own patents, but it provides a significant amount of stability to the stock, because the company does not have to worry about research budgets or future obsolescence as a result of more sophisticated competition. As a result, it is significantly smaller than big chip foundries and design shops, but this specialized technology company pays a consistent dividend, which makes it a worthwhile investment despite its low share price and low valuation. Number 4. ENLC Midstream LLC, ENLC. ENLC provides energy transportation and storage for natural gas and natural gas liquids through a network of pipelines totaling 11,900 miles and nearly 30 processing facilities located throughout the United States and Canada. It's reasonable to assume that, as a midstream energy stock, it wouldn't have had the same kind of explosive growth that we've seen in big oil giants or small exploratory businesses. However, ENLC has experienced strong growth in recent months as a result of a rebound in natural gas demand following the COVID-19 related disruptions. As a result, the company's stock has increased by an incredible 110% in the last year. Even after this run, though, it is only worth around $8 per share, and it recently increased its dividend to 11.3 cents each quarter, giving it a yield that is more than 4 times that of the typical S&P wink with tongue sticking out 500 corporation. Number 3. NatWest Group plc, NWG. National Westminster Bank, situated in the United Kingdom, is another example of a cheap financial stock that is profiting from the global economic boom as well as the special benefits that rising interest rates provide for businesses that have large cash hoards at their disposal. Even though NWG has assets of little more than $1 trillion, it is a major player in Europe, despite the fact that it is not well known to most investors in the United States. And, despite the fact that it does not follow the predictable quarterly cycle of domestic equities, its dividends over the last 12 months have resulted in a yield that is about twice that of the normal large-cap stock at the moment, despite the fact that its stock price is just approximately $7. Number 2. Prospect Capital Corporation, PSEC. Incorporated in the United States, Prospect Capital Corp. is a closed-end investment corporation. With debt and equity investments, it seeks to provide current income, as well as a long-term capital appreciation for its shareholders. For acquisitions, divestitures, expansion, development, and recapitalizations, among other things, the corporation invests largely in senior and subordinated debt and shares of private enterprises. Its interests include lending in private equity and sponsored deals, direct investments in enterprises, investments in structured credit and real estate, and investments in syndicated debt and syndicated borrowing. It is another financial stock that is now incredibly affordable on a per-share basis, with the stock trading for less than $9 per share at the time of publication. PSEC is classified as a business development company, or BDC, which means that at its foundation, it is an investment corporation that is on the lookout for new business prospects. Consumer goods manufacturers, energy firms, and healthcare companies are all represented in SEC's extensive range of investment opportunities. This diverse portfolio of investments contributes to the consistency of the company's 6-cent monthly payout. Because of its emphasis on investments in smaller companies, PSEC can experience short-term volatility as a result of economic trends. However, if you're in it for the long haul, the company's high yield and low share price make it a compelling investment option. Number 1. Yamana Gold Incorporated, AUI. Its primary assets are long-life production assets, including development stage properties and exploration properties, located throughout mining-friendly jurisdictions across the Americas, including Canada, Brazil, Chile, and Argentina. Its primary asset is significant gold and silver production. Its secondary asset is exploration properties located throughout mining-friendly jurisdictions across the world. Through sustainable expansion and optimization initiatives at its existing operating mines, the development of new mines, the advancement of its exploration properties, and at times by pursuing other consolidation opportunities with a primary focus on the Americas and other parts of the world, Yamana plans to build on this foundation. The company is committed to operating responsibly and honestly in order to increase long-term returns to shareholders and align business and societal outcomes by generating transformational benefits for all stakeholders in order to boost sustainable returns to shareholders. Securities in Yamana are traded on 3 stock exchanges: the Toronto Stock Exchange, the New York Stock Exchange, and the London Stock Exchange. Yamana is an intriguing inexpensive dividend investment for a variety of reasons, especially at its current price of under $4 per share. Starting with the fact that its mining activities are bringing gold out of the earth, it is a bet that is connected to the larger trend of inflation, since gold prices are being pushed up by inflationary pressures, as is the case with so many other materials today. Additionally, because it is a smaller miner with a market capitalization of about $4 billion or so, even a minor movement in gold prices can have a significant impact on the company's bottom line. The company's estimated earnings per share in fiscal 2022 are 28 cents, with annual dividend payments totaling approximately 12 cents, making the likelihood of a rise in dividends a realistic possibility. All of this, together with AUI's low share price, makes it a worthwhile investment. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.